Okay, good afternoon, everyone, and thank you all for joining today's event, A Doctor's Guide to Financial Planning Through a Crisis. We know the topic of financial planning, both in response to the immediate impact of the pandemic, as well as preparations for managing the coming months and long-term impact, has been weighing heavily on most physicians' minds. We're pleased to be working with our partner, Foster Group, to bring you this timely content and support available through the expertise of our speaker today, Walt Mosier, and his team of colleagues at Foster Group. Before we turn it over to Walt to share a little bit more about himself and begin the main event, we do have a couple of housekeeping notes to share. So while all attendees are automatically muted and video turned off for attendees to reduce the chances of the background noises and the technical difficulties, we do want this to still be an interactive event. The chat functions and Q&A will be enabled throughout today's event, so please feel free to share any comments, questions, or thoughts as we make the way through the presentation. There will also be a dedicated time at the end for a Q&A discussion. If you'd like to pose a question anonymously, you can do so by choosing panelists only in the chat using the Q&A function. If you'd like to raise your hand verbally during a discussion, you can use the raise hand function and we can unmute you when the time comes. The webinar is also being recorded and will be posted on the IMS website and through Foster Group to be available as an on-demand viewing, whether as a reference for those of you joining me today or for colleagues who are unable to be with us live. And now, without further ado, I'd like to turn the event over to our speaker, Walt Mosier with Foster Group.
Thanks, Autumn. I appreciate that. And I'm going to go ahead and share my screen so that we can get our disclosure page up here. Okay, one second. There we go. All right, one more turn the turnstile. There we go. So, hey everyone, welcome to the webinar. I'm Walt Mosier and I'm a lead advisor at Foster Group. So I want to welcome you as well to the webinar today, which we've called A Doctor's Guide to Financial Planning Through a Crisis. For those of you who may be less familiar with Foster Group, we are an independent registered investment advisory firm founded in 1989 with offices in West Des Moines, Iowa, and Omaha, Nebraska. We have the privilege of serving over 1,400 clients across the United States, of which over 500 are healthcare professionals. Well, today's topic relates perfectly to our vision of coming alongside those we serve to help them live lives of meaning and generosity. We help people do that by serving them in the areas of financial planning, investing, protecting, and giving. Ultimately, we believe our role is to help ensure people's financial lives are truly cared for, and that work does not stop because of a crisis. All right, let's get started. Now, if we were all in the same room together, I would probably use this question as an icebreaker. You know, what brought you here? Why did you come to this event? From extended education requirements and training thereafter to income adjustments that can feel dramatic and life-changing, physicians face opportunities and challenges that are really unique in the healthcare industry. You know, residents can experience spikes in their income that can lead to a sense of relief that all the hard work and the long hours finally have paid off. And this in turn can lead to major forks in the road, and the direction that's chosen will say a lot about how financially successful a physician will be at age 50, 60, and even 70. I think I would be remiss to kind of ignore the elephant in the room. And we all know that COVID-19 has been a serious trial for all the first responders, and especially doctors and their staffs. We know that many physicians and their staff are idled, furloughed, or told to cease operations for a period of time. We also know that the stress and anxiety this has caused has been at an extremely high level. I did some research. You know, I didn't want to be sort of deaf and blind to this issue, so I looked out at I think it was Medical Economics website, and I found a survey And these were some of the statistics that were listed on the survey. And, to say it was jarring, I think would be an understatement for sure. Understanding that burnout rates and just stress levels are at near all-time highs. 63% reporting severe and near severe stress levels in the past 4 weeks. This survey was only done 3 weeks ago. You can see on the bottom, the June 12th through the 15th. So Foster Group is certainly empathetic to all the realities that you all face. And we may not be as keenly aware of it as you are, but we wanted you to know that we understand. We may not feel it the same way you all do, but we certainly are trying to understand that. I kind of broke this down in terms of, for physicians, the early career, mid-career, and late career. So let's talk for a minute about career paths in general. Over the weekend, the 4th of July, I spent some time with family, and I was talking to a young nephew who isn't even, I don't think he's even quite a teenager. And he was telling me how he wanted to work in fast food and the reasons why. And, I kind of looked at him quizzically and I said, why do you want to do that? And he said, well, I want to learn how to interact with people from all walks of life. And I said, oh, that's an admirable thing. But I added that, maybe the great thing about working in the fast food industry was you figure out pretty quickly, what you don't want to do for the rest of your life. And his parents were agreeing with me, but that would obviously be part of someone's early career. And but we want to talk about what doctors' different career stages look like. And we know, for example, that the reality of going to school for as many years as they do, and followed by residency and fellowships, that your actual career of earnings is quite compressed compared to, kind of most people who come out of college and maybe get an MBA or something. And so that presents some unique challenges because you have fewer years to pay off your debt, to save for college for your kids, to save for retirement, and do all the things that most people would maybe have 40 years to do. You're trying to do it in 30 or less. So one of the things I wanted to lay out here was what are things that are happening or should be happening in these different stages. And in the early part of most physicians' careers, they're trying to build a rainy day fund, make sure they've got cash on hand for those unexpected life events. And then a lot of people come out with school debt. So if you have a mountain of debt coming out of undergrad and then med school, paying off that school debt is a big deal for a lot of physicians. And there's really two methods that you can use to pay that off. There's the so-called snowball method, which is where you build motivation by paying off your smallest balances first. And so kind of ignoring the interest rate environment that you're under and paying off those small balances first, and then applying those dollars to paying off the next smallest balance. And then just kind of building momentum from there. And the other method is called the avalanche method. And that's where you kind of tackle the high interest debt first. And then when you get the highest interest debt paid off, then you work towards the loans that have the lowest interest in that sort of order. But then obviously, maybe not obviously, but most people have a family and they want to protect their family. So one of the biggest risks for physicians is how do you prevent or protect your family in the event of your premature death? And that's the easiest way to do that is through life insurance. Now, term insurance is pretty cheap when you're young. Full disclaimer, Foster Group does not sell life insurance. So if you're thinking that, this is just a pitch, we don't sell any life insurance or disability insurance or long-term care insurance. We're not licensed to sell insurance. So I'm not saying that to be self-serving. I'm saying that because it makes sense for most people who have high incomes, a lot of debt, and young families. And then the fourth one there is to save and invest, but that's probably going to take a little bit of a back seat early on as you're trying to tackle these other things. My final point on this slide is to beware of the so-called, I call it the pent-up demand trap. And I've seen this occur with physicians. They come out of residency and they're not making very much money until they really get through all of their schooling and training, and then suddenly they might get this big increase in their income, and many feel as though they've sort of, they've deserved to live a certain lifestyle, let's say, and so they go out and purchase, luxury vehicles, very large homes, and some of that stuff. And I think that some of that is fine. You want to reward yourself for all the hard work, but I think if you go too far, it can end up sort of just causing a tougher time to create the wealth that I think that everybody's looking to create. Let's transition over to mid-career. Here's where most people would aggressively save in their 401ks, their employer-sponsored retirement plans, and that's where it really kind of, I guess, the rubber hits the road there. Paying for college, kids, obviously there's 529 accounts, and those are a great way to save. If you're not able to put all the money into a 529 account during those younger years, then you can just pay the extra maybe from cash flow. I think for mid-career physicians to consider the structure of their balance sheet. So by that, I mean, if you put all of your money into, let's say, the 401k or IRAs, you have to think down the road, what's that going to look like when I start to take that money back out? So maybe you don't want everything that's going to come out to you as taxable income, and you want to balance that. And I'll show you maybe a way to do that here in a few slides. But think about the tax nature of all the investment accounts that you're creating. And not just investment accounts. Honestly, a lot of physicians invest brilliantly in surgery centers, in the offices where they practice. They own the real estate, or they own maybe they own the building or part of the building. And so that's what I mean by consider the structure of your balance sheet. What are the assets that you're building on, and how do they interface with each other? I think you'd want to track your progress at this point with some regular updates, kind of knowing, if you're going from point A to point B, how are you doing in terms of getting there? I was in the Navy, and if I want to go from San Diego to Hawaii and I plot a course, I don't just set sail and ignore the wind and the waves and all the things that can buffet me throughout the journey and cause me to have to readjust my course. So understanding what it takes to get there is important. And then the last one there is protecting your peak earnings. If you're in your late 30s, 40s, early 50s, you're probably making the most money during your career, and being able to protect that with maybe some disability income. I'm not a big disability insurance, excuse me. I'm not a big insurance person, but I do think it makes sense to protect earnings for certain specialties or certain occupations. In the last section here on late career, accelerate your established savings habits. So maybe save a bit outside your 401k. Again, really examine what your balance sheet, what do your assets and liabilities look like, and tracking your progress again, and protecting your peak earnings. I think, in terms of the balance sheet construction, so here's an example of what I mean. Let's say you're 62, you're honing in on retirement, and you want to buy a second home in Florida or Arizona for $250,000. And so if all you have to pay for that is an IRA, it might cost you a gross distribution from that IRA of $350,000 or $400,000, just so you can pay the tax man what you owe the IRS, and then net that $250,000 you need for the house. So you probably don't want to do that, and that's why it makes sense to have some money in other types of accounts, whether it be cash or personal investments, things that maybe are taxed a little differently. It's also important to draw up plans for both exiting medicine and transitioning to a life where you stop saving and begin taking withdrawals from your nest egg. And this can be a mechanical, it can be a psychological, it can be an emotional adjustment, just to go from working to not working, and understanding what it takes to cross that threshold. High income is not the same thing as net worth. And this is maybe seems like blocking and tackling for some people, but income is money received from active or passive activities like salary, bonuses, things like farm rent, trust income, or rental income from real estate. All of that comprises the definition of income. But net worth, which is what you really should be working towards, is the sum of all assets less liabilities. Generally, it's the result of how a person manages their income and expenses. And there's one really easy way to build net worth, and that is to spend less than you make and take the excess money that you have and put it aside for yourself. So the key point in red is that, a person can have high income and high net worth. They could have low income and high net worth. They could have high income and low net worth because they spend it all, or they could have low income and low net worth. There's any of those combinations can occur. And it's really about how you manage that free cash flow that's going to decide what net worth you end up with at 60 or 65. We know that life expectancies are expected to continue to grow. And, the last time we did a census in this country was 10 years ago. Back then, there were 1.9 million people over the age of 90. And Americans 90 or older made up about 4.7% of those people over 65. I'm sure you see those in your patient makeup. But by 2050, the 90 and over crowd is going to reach 10% of those over 65. And there's some of that is driven by demographics, as you know, and some of it by better healthcare and better medical practices. So, data points like this really drive a lot of concerns among savers and investors about how long their resources are going to last. I found kind of a funny cartoon I'll share. It looks like a couple of octogenarians strolling through the park, and he says, his phone rings, wait a minute, I have to get this, it's my mother. And so I thought just to lighten it up a little bit, I'd throw that cartoon in there. All right, let's talk about buckets of money. Everyone likes to talk about money, so let's address this from this tax viewpoint of 3 distinct buckets of money. So here's where we get a little bit tactical. We're going to start off with what I call the pre-tax bucket, and then there's also the tax-free bucket. So starting on the left of your screen, the money that goes into this bucket is going to go in as your employer payroll deducted 401k contributions. Now you could do Roth 401k if you're young and it makes sense. But a lot of people just do traditional 401k, and that money is tax deductible. It comes out of your paycheck before taxes are applied. The money that grows in your 401k is tax deferred. So that means all interest, dividends, capital gains, etc., are completely tax deferred until when? Well, ultimately until the money comes out at some future date and turns into an income stream for you. So those withdrawals are taxable as ordinary income, which just means it's kind of taxed the same as your salary, except not for the FICA, the Social Security, and the Medicare taxes. Those do not apply to IRA or 401k withdrawals. So on the tax-free side, money that goes in is actually after-tax money. They're not deductible. You do get tax deferral on all the growth that would accumulate from appreciation, interest, dividends, and capital gains. And then the nice thing about the Roth bucket or the Roth IRA 401k is when the money comes out, it is completely tax-free under current law. So if you're a young person and you've got a lot of time on your side to put money away for yourself, the compounding effect of years and years of growth might mean that a Roth 401k makes a lot of sense for you. So those are two of the three buckets. And there's one more, and that is the after-tax bucket. So think of that as just like your standard brokerage account. The money that you would put in would just be money that you've earned. You've already paid tax on it. So it's not deductible. There is no tax deduction associated with this after-tax version. There's also no tax deferral on any growth. So if you have investments that pay interest or dividends or capital gains throughout the year, you're going to pay some sort of a tax on that money. You'll get a 1099 at the end of the year from the investment company, and then you're going to have to pay either capital gains tax or income tax on that. The withdrawals, however, are taxed at capital gains rates. So you can see right out of the gate, you've got a bucket that's taxed as ordinary income, some that's taxed at capital gains, and some that is tax-free. So back to my example of, let's say you want to buy a second home in Florida or maybe Arizona, and you want to access some of your investments to pay for that home. It's probably not a great idea to pull it out of this bucket here, because that's going to be very highly taxed. This one is going to be taxed more favorably, and the Roth IRA is going to be the most favorably taxed. So it just gives you flexibility, and honestly, depending on what Congress does with tax laws in the future, having a relative equality among these three buckets is going to give you the most tax flexibility in terms of deciding which lever to pull to take money for yourself and for your lifestyle. So I hope that makes sense. These buckets of money there's nothing fancy or special about them. It's just based on how the tax code is written. And I guess the point here is that you have options, and you should really think about those options as you're saving for yourself. One more quick slide on the difference in tax rates. So for many of you, I think you're probably going to be in those higher tax rates under the ordinary part of that table. But let's just use an example, and let's say that you're in the 22% marginal federal tax bracket. If that's the case, you're also in the 15% capital gains bracket, okay? You can be in both of those brackets at the same time. The point, though, is if you've got money that's invested that's subject to a 15% tax versus a 22% tax, which one would you rather pay, right? It's a rhetorical question. You'd obviously pay the 15% instead of 22. But I guess I just want to draw some attention to the fact that capital gains rates are generally lower than ordinary tax rates when you do that quick comparison. All right, let's get more to the point. And what about planning through a crisis? When I was 8 years old, I remember sitting in a gas line with my dad, and it was due to the Arab oil embargo in 1973. You notice this chart goes back to 1970, but this is essentially a stock market graph, and it puts on here all these different not calamities, but crises that came along during this entire period up to modern day. But at 8 years old, I remember that something was different, and there was a crisis that was affecting our lives. And I was sitting there waiting to buy $10 worth of gas, in a pretty long gas line. But let's look forward. I was in college when the Dow dropped almost 25% on Black Monday. That was a fairly steep, short-term but steep crisis. And then, of course, we had the 9/11 terrorist attacks, and we had the dot-com bubble bursting. My point with showing you this graph is that even with the last Great Recession, the market continued to advance over the long term during all of these crises. And to try to time when the market's going to fall or try to guess when it's going to go up, it's really almost impossible to do that. And the most successful investor in the world just down the road in Omaha made this quote about forecasting, and I'd say he has it just about right, that uncertainty is part of our lives, and we don't need to tell you that. Nobody had predicted a pandemic last year. Nobody predicted COVID, but that's just one aspect. I mean, look at all of the uncertainty around employment and around sport scores, or in fact, we're not even really playing much sports now, but in general, sports and the weather and the economy, it's all uncertainty. And so we don't believe you can predict the future or the future investment markets. The market timing really doesn't work because the future is just unknowable. Loud voices tend to appear after the fact and engage in a lot of armchair quarterbacking, but it really doesn't add much to the conversation. It's generally not helpful, nor are these folks able to build a better investment model. Okay, there are two rules of thumb that you can put in your hip pocket and use this on your friends and family at the next backyard barbecue. The first is known as the rule of 72. So it's sort of a fraction. You just take the number 72, and if you divide it by whatever assumed rate of return you think you're going to get on your investments. So just to make the math simple, I'm dividing 72 by 7.2%. And it tells you how quickly your portfolio is going to double in value. So 72 divided by 7.2 says 10, meaning that your money would double in 10 years if you actually earn 7.2%. Most people don't have a consistent, return like that. So that's how frequently your money will double, not including withdrawals or contributions. Like, you really can't use this rule on a 401k because you're always putting money in every month. But if you just had a static portfolio that you weren't adding to, you could roughly come up with how quickly that money should double. And then the second rule of thumb is the rule of 115, and that tells you how long until your money triples in value. So 115 divided by 5% gives me 23 years, and that would tell me until I get the triple the value of my portfolio. So just something as a takeaway there, kind of a couple little fun facts. All righty, let's look at how a nest egg tends to grow after retirement. And I just blew up the lower left of this graph to show you a little bit bigger detail. This is a couple, hypothetical couple, ages 66 and 62. And you can see that they have about $750,000 to start retirement, okay? So the graph then grows. Each of these represents an individual year, and you can see they're aging along the bottom here, just shows their joint ages. But you can see the portfolio grows and it crosses the $1 million line. Here's 1.25 million, and it keeps growing. And then somewhere out here, pretty late in life, it kind of slows the growth process and starts to maybe drop just a little bit. And so this is the kind of graph that you might see if you're applying a linear growth rate, let's say 6.2% a year for that entire 30 or 35 year retirement. And what happens is people continue to spend. Sometimes they're spending due to inflation and cost of living adjustments. It tends to exceed the ability of their money to keep growing in this fashion where the slope is positive. So what happens if we want to introduce some market volatility or variability, because we know returns are all over the place sometimes. And we have the ability to introduce what's called a probability of success number. And so for that couple, that number was 93%, which means it looked on paper like they had enough, but when you introduce 1,000 different random market scenarios and you kind of put them in a big tumbler and come up with a percentage, it'll basically make that a little bit more real world. So we target 85% to 100%. 93 is pretty good. That doesn't mean there's a 7% chance that they're going to completely run out of money. What it really means is there's a 7% chance that they might have to make some course corrections and tighten their belt during a recessionary period. But the measure of success for this is if you have $1 left at age 95. We tend to use age 95 as a life expectancy. So we really kind of track this pretty carefully. But what if you just retired? Here's the same graph, but what if you had just retired and suddenly you had $100,000 unexpected expense? You got to pull that money out of your investments. We know that life happens, unexpected things occur. Years ago, this is a client that called me, not a foster group client. You don't know who these people are. But I got a call from a client who said they needed to withdraw $60,000 from their investments. And as I listened on the phone, they described how one of their granddaughters had become hooked to some kind of a substance abuse. And they needed $60,000 to put her into a special school where she could learn and also go through detox. And so for them, that was a personal crisis. It wasn't necessarily a market crisis, but it was one that impacted their portfolio because it occurred, let's just say in this example, it occurred at the very beginning. So we could build that in and we could retest for that probability of success number. And for that example, if you took 100,000 out right at the beginning, their success would drop to 83%. Not completely devastating, but it's impactful enough that we would want to help them recover from that and just have a conversation about how do we manage that going forward through, reduced expenses or adjusted lifestyle. What a lot of people think about is the long-term care issue. So here we have a normal retirement graph up until the point where the husband, that's what the H is, husband needs long-term care beginning at his age 90. So I've introduced a $90,000 per year expense. That's $250 a day in a skilled nursing facility and lasts for 5 years until he ultimately passes away at age 95. So in this example, they don't have long-term care insurance. So the spend down could be quite dramatic. And when modeling retirement planning, it's really important to consider these types of contingency events. All right, let's move on to what we would call your financial lifeboat. So one way, now we're kind of looking at people who are retired. Let's just say you have a $500,000 portfolio, you're living on your money. Suddenly, February 21st happens and the market starts to drop, and then 30 days later we're down, 15, 20%. What can you do? Well, in this example, which is just hypothetical, let's assume that 40% of their money was in bonds and 60% was in stocks. The financial lifeboat they have at their disposal is right here. It's the 40% in bonds, because if you buy high quality bonds, you would have $200,000 of liquid investments that should be, relatively stable. History tells us that bonds generally maintain pretty good value. And so let's assume that 200,000 here is in bonds. Well, if you're taking 20,000 a year out of your portfolio, let's just say that you are, to cover expenses. So in the event of a market downturn, stock prices generally fall, but the bonds historically maintain their value and can provide that income even during maybe an 8 or 10 year period. So in this example, we started with 200,000. And so if I'm taking 20,000 a year, I apply a 3% inflation rate. You can kind of see, how it increases on the right there. But ultimately, you probably have enough for 8 or 10 years of lifestyle if we had a recession or a market downturn that lasted that long. We also know from stock market history that the longest period of peak to trough back up to the peak was 8 years, and that was during the Great Depression. So, you can say lifeboat, or you can call it a life, a life ring that you throw in a pool to save somebody. But the point is, it should help you weather a major economic storm during the kind of times we just lived through. A lot of people ask, when I do retire, how do I know how much I'm going to need to pull from my portfolio? And frankly, when am I going to need to pull it? This also ties in with when do I take Social Security, or, if I have a pension, when do I take my pension, or when do I live on my rental income from the surgery center that I now have available to me. So I normally would say, if you're not a numbers person, this would be the point in the webinar where you'd want to, sit up in your chair, put your hand lightly on the eject button, but don't press it yet. But I think most docs are probably pretty okay with numbers. So let's take a look at some. This table starts out with a 5-year cash flow. So here we are. We're going to start off. We can see our hypothetical couple here, ages 64 and 68. And there's one of them is making a income of 156,000, goes up for the next year, and then it drops off. And that's the point at which the breadwinner has retired, and you've got a partial year income there. and then 0 for 23 and 24. Also, we have a spouse that's collecting Social Security. You can see those numbers. The wife has a pension, and then RMDs stands for Required Minimum Distributions. And you'll notice that this number, this 26,000, kind of lines up with the year in which the older spouse turns age 72. So that's what that represents. So what you can see is you've got pretty strong income the first couple of years, then it drops off, and then it drops a little bit more, and then it goes back up. So kind of all over the place. Now let's look at their expenses. So that was income, this is expenses. And you see that their normal living expenses is kind of between 75,000 and roughly 80,000, adjusting for inflation. These first couple of years, this is essentially the miscellaneous money that they made that above which they needed, and we're just assuming that they spent it. So think of that as like ATM withdrawals or withdrawals at the grocery store when they pay for stuff. Debt payments are pretty level, and insurance premiums are the same. Taxes are going to be different depending on what their income is for that year. And then planned savings at the bottom here. This was just the money that the breadwinner was putting into the retirement plan, the 401k. Okay, so now we go to the combined table, and it's essentially the same numbers I just showed you, but I want you to focus on the bottom here. So the numbers in red is the net negative cash flow. That's the amount of money that these people are going to need to pull out of their investments to cover a shortfall. And the shortfall is, the difference between what they're bringing in from other sources and what they need to pay their bills. So you can see those in 22 and 23, they're going to need between 65 and 70, 71,000 a year. And then in 2024, remember we have that required minimum distribution that starts. So that's going to come out of the IRA or 401k. So that covers some of the shortfall, but the rest is going to have to be taken either from the IRA or from another investment bucket. So this is just a kind of a way that we can map out for people how that cash flow is going to look even during a transition. So this is intentionally created to make it look like you got retirement happening in the next couple of years, and then answering those questions like, where's my money going to come from? So yeah, again, this is just kind of highlighting the difference in the inflows, but we kind of went through that. Well, what about some other, what about some other transition considerations? I just put some on the slide here, things like, when do I retire from work? Do I work part-time, or can I do consulting in some fashion? Maybe something I always wanted to do, but now I have the chance to do it after I quit my full-time work. People have questions about how and when to begin Medicare and Medigap policies. That's sometimes I think is oversimplified a little too much. There's quite a few different traps that you have to be aware of, especially if you work beyond age 65, in terms of when to file for Medicare Part B and Medigap policies, the so-called Medicare supplement policies. Or even if you retire early, what about purchasing health insurance before 65? The ACA is out there, but it's there's some problems with it. When to begin pensions, when applicable. I know a lot of docs don't have pensions available to them, so we don't really see that a whole lot. When to begin Social Security, when to begin withdrawals, as we just talked through. What about opportunities for Roth IRA conversions? If there's a couple of years where taxable income is near zero, or maybe in a couple of lower tax brackets, there could be a good time to think about absorbing or soaking up some of those lower brackets with a Roth conversion possibility. And then blending income types for income tax management. That's that buckets of money discussion. Or, do I still need to pay for the life insurance that I've been carrying? If you do have life insurance, you just have to think about, what's the purpose of it now? I don't need it to protect my family against loss of income anymore. Maybe I want to retain some for final expenses, funerals, those kinds of things. Or it could be other reasons, like to, leave some tax-free money for your kids. All right, another cartoon. I like Dilbert, one of my favorites. The guy in the lunchroom says, I retired from my life of corporate crime and put all of my illicit earnings in a mutual fund, to which Dilbert replies, how do you know the mutual fund is legitimate? And he's sort of shocked by that. And then Evil Boss Man says to Dogbert, we got all the money back? Dogbert says, we? So this cartoon speaks to the concern that some folks have around money, security, and legitimacy. So let's talk about that. There is a website that you can go to check out your investment professional. And this is what it looks like. It's investor.gov. You could literally type my name or any other advisor's name into that search box and learn about if there's any disciplinary action or complaints. Basically, it's a database for seeing if there's anything sort of, unscrupulous or unknown about a particular advisor. It's a way to kind of snoop on people. Or you could also put in the firm name. So you could put in Foster Group and check them out. I can save you a little bit of time. I've already done a little bit of that homework for you, and I didn't see anything out there on me or the firm that would raise any alarms. But if you're going to hire somebody to help you with your money, at least take 5 minutes to check them out at a basic level. This website is actually run by the Securities and Exchange Commission, so the SEC, and some advisors are actually regulated by the states, and it just depends on some facts and figures about them. But this is a good place to start, so I would encourage you to check that out. Just do your homework before you make a decision to work with anybody. What about other planning issues, things like premature death? What about a survivor scenario? And estate planning needs. There's powers of attorney for healthcare, powers of attorney for financial matters, revocable living trusts, and last wills and testament. How do you know which is right? Turbulent markets. I mean, we just kind of came through some of that. So if you hung on, grabbed onto the grab bar during that period, you know what that's like. Generational wealth transfer. How do you retain and pass money to your heirs? Generosity is kind of interesting. I actually have some advanced training in terms of people that are charitably minded. You can give. A lot of people think it just involves writing checks to charities. You can actually do some unique things where charities will pay you an income during your retirement, and which is not something most people think about. Business exit planning, long-term care, lots of things that could be part of the conversation there. All right, so in conclusion, as I see it, you really have 3 ways to kind of, create a net worth. You can ignore or hope that things work out, or just put money aside and expect that it will be there in a certain amount down the road. Obviously, we don't think that's the best way to do it, because we're in the business of helping people to achieve success. And what we do find, though, is many people do some planning on their own until they reach a certain scale. Maybe they hit a certain net worth and they start to wonder, are there any blind spots in my plan? Are there things I'm not aware of that could help me or even protect me from a mistake? And so number 2 there, is kind of the do-it-yourself or the DIY. You could read books, articles, magazines, websites, a lot of content out there. Not everybody knows how to put that stuff together or even has an interest in it. And the third option really is to hire an expert. And it's a funny story. I need a quick repair done on my car, and so I got a quote from a repair shop, and I didn't really like the quote, so I started doing some research online, watched some YouTube videos, and I watched 3 or 4, and I thought to myself, I could probably do this, but if I drop the bolt down inside the engine compartment or do something that I didn't expect, I could really regret doing that. So I told my wife, I said, I think I'm just going to have the repair shop do the repairs. So I don't work on my own cars, and there's a reason for that. So I will say that at least half the value of hiring an advisor is in the accountability that the advisor brings to the relationship. A lot of married couples are accountable only to themselves, and that's easy to let slide or procrastinate. And so if you are accountable to a third party, and that third party is saying, hey, you said you were going to do this, did you build a rainy day fund, or are you putting the maximum in your 401k? Those are the kind of things that I think bring value even outside of all the technical expertise or the recommendations. So I'll just wrap with that. And at this point, we are able to take questions. I want to thank you for your attention and for attending. You can reach out to me or check out our website if you're interested in learning more. But I will actually, I'll just turn it back over to Autumn at this point and see if we have any wrap-up discussion.
Perfect. It looks like we have a question from a member. It says, I know we talked about the inherent limitations of forecasting, but are there any current modeling projections offering some valid guidance or expectations for what we reasonably expect to see in the coming months, COVID-related and or election year based?
Yeah, that's a fair question. I think everybody kind of wonders, what is coming next? And yeah, I cannot personally think of any resources that would really have detailed forecasting. We don't really subscribe to that. And I would say, if you're looking for something that maybe would help you become more comfortable with your investment strategy, then maybe we should re-examine your investment strategy, because investing long term does mean accepting some risk, and that's where we typically start with those conversations around what is your time horizon for this money, when are you going to need it, and just investing in a way that allows you to sleep at night, gives you some peace of mind. But I think for those who maybe try to outsmart the market, there's always two decisions you have to make. So let's say that you time getting out of the market correctly, and so you made the right decision, but most people will not make a second right decision, which is when to get back in the market. And I remember back in 2008, some people were panicking and wanting to get out of the market, and so they did. It was their money and they went to cash. But if you think about when the low point was in March of 2000, it was March 9th of 2009. And I remember the Dow was like at 7,600 or something like that. The S&P had dropped 52%. Most people were not emotionally prepared to get back in on that day, which would have been the ideal day to, participate in the complete recovery and run up. And so, I just don't think that strategy works. And I would say maybe put more money in cash if you're not comfortable with where things are going for you. But no companies that I'm aware of. There probably are some out there, but I don't know anything about them. So a bit of a punt on the answer, sorry.
Okay, another question. How important is prioritizing investing when cash flow is proving to be difficult during this pandemic?
Oh, I think if cash flow is tight, then you just need to focus on cash flow and paying your bills and covering your expenses. I mean, investing would take a second chair for sure. You wouldn't want to be investing now and then putting yourself in a precarious position in terms of having enough money to, face an unexpected expense or just pay your normal monthly bills. Yeah, that's kind of an easy answer. Investing should always take a back seat to making sure you have enough cash for yourself, your family, and then a rainy day fund. That's just kind of I guess that's financial planning 101.
Okay. A lot of what has been touched on tonight has been focused on personal financial planning and investment. Have there been experiences or best practices that you've seen among the physicians and groups you work with related to practice management and financial planning for your business practice?
Yeah, that kind of bleeds into a whole nother area. I touched on it with the exit planning, but I know there are advisors that touch on helping business owners or professionals with their business practices. But I think that to be fair, I would say that's a little outside of our skill set. Having said that, I know that there is some training. I'm actually taking some training in August to help business owners primarily prepare to sell their businesses. And so I personally don't have that training. And as far as doctors and doctor groups, I don't know. I would have to check with some of our other colleagues here. I don't know that we really dive into, helping docs do that. I know there are management consultants that do that kind of work. And I would probably guess that even through, IMS, that maybe you have affiliations with folks that do that kind of work. But it's really outside of our area of expertise.
Great. Have you seen any generational differences beyond the standard career stages that have seen in how people are investing?
Oh, just among different generations, like say Gen Xers versus baby boomers versus Gen Z.
Yeah.
That's a good question. I would say that not really. I mean, I think there are probably differences in terms of how the generations have been impacted by some of these, large scale economic resets. I think if you were probably in your 20s or early 30s and you lived through the Great Recession, maybe you saw your parents lose their jobs or even lose their house, or things like that that would be pretty traumatic. Or let's say you were even not in your 20s, you were a teenager and one of your parents or both your parents lost their jobs and struggled. I think that would have a pretty heavy psychological impact. I don't know to what extent, whether it would make you save more aggressively or go the other way and kind of give up on the investment systems. But I think those are the kinds of events. And now this one with the COVID, I think this will probably have a pretty long lasting impact. I mean, I'm just giving my opinion here. I have nothing to really back it up. But I would say that those kinds of things may have more of an impact on generations than some sort of a innate systemic generational difference.
Thank you. Well, it looks like those are all of the questions we've had. So I just wanted to thank you, Walt, for sharing your information. And thank you to everyone who was able to join us tonight. As a reminder, a copy of this recording will be available within 24 hours. So we encourage you to share that with colleagues and partners. So thank you, everyone. Have a great evening.
Thank you.